welcome everyone. Welcome back to the recordings of corporate financial reporting. The topic of discussion today is different types of investments and marketable securities. We have already done one discussion regarding this topic in the chapter discussion of it was chapter number 17 of marketable securities in this corporate financial reporting topics. Today we will be solving some exercises regarding this chapter. So let's start our discussion. This is question number 17.2, which I have chosen for discussion's sake. So let's read out the instructions and try to solve it. So early in 2012, Yon Industry purchased marketable equity securities for $5 million. This is actually the investment by Yon Industries in the equity securities, and the amount they invested, that was 5 million. These securities are classified as available for sale. You know that marketable securities could be classified as trading or could be classified as available for sale. Here they are classifying them as available for sale. To acquire these securities, the company incurred transaction cost of $30,000 in addition to the 5 million. So 5 million was the purchase price, but in order to register and do complete the transaction, they have also incurred this $30,000. So together, it's going to be the complete cost for these marketable securities. The securities has a fair value on 31st December 2012 of 4.6 million. So this is the fair value at the end of the year. None of these shares were sold during that year, so there was no sale happen. So requirements is what amount would appear in the asset account when the securities are bought. As I already said, that 5 million is the purchase price plus this 30,000 is the acquiring cost. Together it's going to be the cost of these marketable securities. So this will be basically 5.03 million, you can say, or 5 million and 30,000 will be the cost of these marketable securities. Make the journal entry required at the end of the year to reflect the fair value of the securities. Now we all know that marketable securities are required to be compared at the end of the year with their market value. So the book value is always compared with the market value. If the book value is greater than the market value, we always have unrealized holding losses, because book is more but the market is willing to give us less. Whereas if the book value is going to be less than the market value, market is willing to give more, so we will be having unrealized holding gains. Now the question is where this unrealized holding loss or gain will go. So it depends on which type of securities we have. If we have trading securities, they are going to affect your income statement. But if we have available for sale securities, they are going to affect other comprehensive income statement account, and it is the part of the equity. So if you see the journal entry, compare, can you see the book value during 2012 was, this is the book value, 5.03 million. At the end of the year, the market value is 4.6 million. It means that market is willing to give less this scenario. So we have an unrealized holding loss. How much? 430,000. Take a difference of it, right? So unrealized holding loss will get debit. You can also write OCI, other comprehensive income, because this is basically an account of OCI, and marketable securities will lose their value with 430,000, so they will decrease. So basically this unrealized holding loss is the part of other comprehensive income, not the income statement, because the securities are available for sale. Let's move on towards another question. In this question we have different parts to solve, so let's read it out. At December 31st 2005, Abbott Laboratories Incorporation owned 50% of TAP Pharmaceutical Product Incorporation under a joint venture agreement with Take That Pharmaceutical Company Limited of Japan. Now what is happening? There is one company that is TAP Pharmaceutical, and its 50% shares are purchased by Abbott. Why? Because it has a joint venture with Takeda Pharmaceutical. So if it is a joint venture, so 50% was owned by Takeda. But right now we are here. We need to talk about this scenario. So here Abbott has influence on tape because the percentage of ownership is 50%. So we will be having not a normal scenario of investment. This is investment in affiliates. Okay, so tape develops and market the pharmaceutical. This investee, it develops and market the pharmaceutical product for the US and Canada, and is an important strategic investee for the Abbott. Abbott appropriately account for the investment in tape using the equity method. Why equity method? Because we know that the ownership percentage is above 20%. Below 20% we follow passive investment methods, which is market method or the cost method, which I did in the previous question. That was market method. But if the percentage is above 20%, then we follow the equity method. The investment in affiliates account, so I said that this is investment in affiliate, is reported by Abbott Lab in its 31st December 2005 balance sheet at 167 million. So at the end of the year, this was the value Abbott was reporting in investment in affiliates account. Abbott received 343, 638 and $606 million dividend from TAP. Three amounts of dividends they are telling us during 2005, 4 and 3. So this is 3 years dividend information. TAP declared income of 883, 1290, 1303 million in these 3 years. So they are in this paragraph. Basically they are giving us two information about the dividend as well as dividend information about the income of tape. At 31st December 2005, TAPE's balance sheet reports assets of 1,470 million, liabilities of 1,136 million, and shareholders equity of 334 million. So this is asset and this is liability and equity. Together it is equal to assets of investee. Now let's see what we are supposed to do. Point number A says that reconstruct the journal entries made by Abbott Lab to account for its investment in tape in 2005 using the equity method. They want us to reconstruct, means re-record the journal entries for 2005 using the equity method. So what happened in 2005? Two things happened. In 2005, the investee has announced the dividend of 343 for Abbott only, not the complete dividend, and the investee income was $883. So we know that Abbott's investment is 50%. So let's record the journal entry. Firstly, when we receive the dividend, cash gets debited 343. No need to take the percentage because this dividend is particularly relevant to the Abbott. So 343 cash gets debited. We are following equity method. I cannot credit dividend income because equity method does not do so. Equity method considers the dividends as a payback of investment, or you can say decrease in investment. So that's why investment in affiliates will decrease, or you can say equity investment will decrease. Okay, and at the same year, what other things happen? The investee has declared $883 of income. This is not for Abbott, this is the complete income of tape. So how much belongs to Abbott? 50%. So according to the equity method, income of investee, our contribution is considered as our income. So 50% contribution by Abbott, so 50% of the income of tape is the revenue for the Abbott. So investment account will increase because of this. Also it's an you can say income from the affiliate. You can write income from affiliate, you can write equity income, both are fine. How much? The total income was 883. 50% belongs to Abbott, so that is 441.5 million. Point number B. Assume that Abbott acquired the investment in tape at the beginning of 2003. How much did Abbott pay for the investment? So they said that information in the question is for 2005, 2004 and 2003. They said that the investment was made in 2003. So every year they actually want us to tell us how much money we invested when we purchased this 50% ownership. So do remember, we might have invested some amount, we don't know, but every year this amount increased because of the profits. Can you see? Investment in affiliates increases because of the income or the profits of affiliate, and it decreases every year because of the dividends. Can you see? Dividend decreases the investment in affiliates. So if we do the reverse, let's deduct all the income which we already added. So let's subtract all the income and let's add back all the dividend which we deducted. So by doing the reversal, we will be able to know what was the original investment, right? So let's do that. The current investment, they showed us in the question, the ending balance is 167. So 167 is the current balance. Let's add back all the deductions we made and let's deduct all the additions we made. So all the additions we made, that was the income from the affiliate. So 50% income belongs to us. So when we took that, we before added it, let's deduct it to remove the effects. And all the dividends has decreased this investment account. So let's add them back to know the original amount. And when I net it off, I came to know that the original investment value was $16 million. Point number C. Assume that 167 million investment in tape represents only 10%, which is passive interest, not 50%. They are asking us change the ownership percentage. Thinks it's 10%, not the 50%. Abbott classifies the investment as available for sale. So available for sale, we know that it's affects the other comprehensive income account in form of unrealized holding losses. The 343 million dividend received by the Abbotts are the result of having a 10% interest. So this dividend, they said, which Abbott received, this is not a 50% ownership dividend. This is because of the 10%. So in that case, I cannot decrease the investment account. I will be considering it dividend income because I will be following the market method, not the equity method. Abbott are okay. Shares of TAP are actively traded, and TAP's total market capitalization at December 31st, 2005 is 2000 million. Can you see? The book value is 167 and the market value is 2000 million. It's huge difference. Compute the effects of investment on Abbott's 2005 income. This is available for sale securities, so this market value comparison is not going to affect the income statement. Income statement will only be affected because of this dividend which you are receiving. So this is what I wrote here. If the investment is passive investment available for sale securities, only the receipt of dividend will increase the income. The market adjustment will be placed in other comprehensive income account in the shareholders equity, not in the income statement. Okay, let's check this question. For each of the item listed below, indicate the effects of the transaction on accounting changes on the current period net operating profit after tax. So they want us to read each and every transaction and shows its effects on the net operating profit. The end of the current period invested capital and current period cash flow from operations. Only first part of the cash flow statement, which is cash flow from operating activities. Set up your answer in the following format. If something increases, write increase. If it decreases, write decrease, or no effect. Okay, so let's check this out. Point number A. The company recorded, okay, I made this solution in this way. This is net operating profit after tax, this is ending invested capital, and this is cash flow from operating activities. Point number A, the company recorded the increase in the market value of their passive investment in available for sale securities. We are doing this again and again in this chapter. So when you record this increase, what you do, you debit the equity investment and you credit other comprehensive income, right? Or you can say the equity account increases. So it does not have any effect on the income statement, so no effect. But yes, ending invested capital will increase. Also, it does not have any effect on the operating activities. Point number B, estimates of expected salvage value or the residual value used in the straight line depreciation method for delivery van were decreased. We all know that the straight line depreciation says cost minus salvage value divided by useful life in years. When this salvage value will decrease, the numerator will increase, and when numerator will increase, what will happen? Depreciation expense will increase, and when depreciation expense will increase, your net income is going to decrease, right? Because expense decreases the income. So that's why your net income is going to decrease. Since your net income is going to decrease, it is going to decrease your retained earning in the invested capital, and it does not have any effect on cash flow from operations because it's depreciation relevant information. Point number C, a large amount of production machinery was sold for cash at more than book value. So when you sell the production machinery at more than the book value, you get cash amount which is more, let's suppose 12,000, and the asset gets credit, right? They said more than the book value. For example, book value was 10,000, difference will be gain, that will be 2,000. So gain is going to affect your operating profit, and it's going to increase the operating profit because operating profit and so net operating profit after tax, sorry. And when the net profit is going to increase, it is going to increase your ending invested capital as well. But it's not going to affect your CFFO because the sale of asset increases your investing activities, not the operating activities of the cash flow statement. Next, the company sold equipment inventory on credit to a regular customer in the normal course of the business. Can you see, it's an equipment but it's inventory. It means that this company sells the equipment. This is their normal job, their normal business, and they sell it on credit basis. So accounts receivable gets debit and sales revenue gets credit. So revenue is going to increase your operating profit, or you can say your net profit, and net profit is going to increase your invested capital. But we are not receiving any cash, so CFFO is not going to be affected. Point number E, cash dividend were declared and paid. So the final effect is retained earnings are going to decrease and cash is going to also decrease. So dividend have no effect on your income statement, so no effect. Retained earning will decrease your invested capital, and operating profit is not affected because dividends are I'll say again, cash flow from operations are not going to be affected because dividends are the part of financing activities. Point number F, a 50% stock dividend was declared and distributed. So when you declare the stock dividend and distribute it, retained earning gets debit and common stock gets credit. Now both of them does not affect your net income, and also your invested capital is not going to be affected. Why? Because retained earning will decrease because of the dividend, but at the same time common stock will increase because of this dividend, stock dividend. So that's why ultimately no effect. Also, it does not have any effect on the operating activities of the cash flow. On the last point, number H, on the last day of the year, interest bearing convertible bonds were converted to the shares of the common stock. So what will happen? Bonds payable will get debit, common stock will get credit, liability will decrease, equity will increase. So that's why I'm writing increase here. Nothing other is affected. Moving on towards point number I. Company delayed the payments for the factory workers, normally due on the first day of the year, by several days. So when the company has delayed the cash payments, so CFFO is not going to be affected. Also, it's the delay in the payment, but the transaction is already recorded, because as soon as employee earn, we record our expense. So because of the delay, cash will be affected, that you are saving it, but there will be no effect on net income or the ending invested capital. Finally, in the prior years, new lease signing was treated as capital lease. Similar new leases signed at the beginning of this year are treated as operating lease. Operating lease is payments are considered as operating expenses, and expenses decreases your profits. Profit decrease If profit decrease, your retained earning in invested capital is going to decrease. And also, at the same time, operating lease is going to increase your payments in CFFO. So that's why CFFO, because it's operations, right? So it's going to decrease the cash from the operating activity section. Finally, the last question for the discussion is, at the end of 2012, Huber Company has investments in trading securities. Till now we were talking about available for sale securities. Now we have trading securities. As follows, amounts are in thousands of euros. So they have investments in 3 companies: Renat Company, Helsing Limited, and Nielsen Financials. Costs are 1000 for Renat Company, but the market value at the end of year is 1300. Cost in Helsing Company is 900, market value is 1100. And for Nielsen Financials, the cost is 1100 and the market value is 900. So total cost is 3000 and the market value at the end of the year is 3300. The share of the each company were acquired during 2012. So the market value shows above are based, so these market value are based on the market prices at the closing of the trading at the end of the year, 31st December. So these are the year end market prices. Point number A says that record whatever journal entries are required to implement mark to market accounting for the Huber Company at the end of 2012. We all know that for the marketable securities, at the end of the year, we compare their book value with the market value and we record any unrealized holding gain and losses. If the type of securities are available for sale, these unrealized holding losses are going to be reported in OCI. But like in this question, they are trading securities, so unrealized holding losses are going to be reported in your income statement account. Okay, so let's record these journal entries. Let's compare first. Renat's market price increased with 300, so this is unrealized holding loss. Helsing also increased with 200, whereas Nelson Financial decreased, so this is unrealized holding loss. The first 2 investment gives us gain, but the third one gives us loss. So in investment account increases, you can write equity investment, you can specify investment in Renault with the 300, and we have unrealized holding. HG means holding gain. I just wrote it in hurry. You need to write the full holding gains, 300. And this unrealized holding gain will be reported in income statement. Same is with Helson, that was 200. And for Nelson Financials, we have unrealized holding loss, and it will also go to the income statement. And equity investment will decrease. Point number B says that based on other information, which type of business would you expect Huber Company to engage in and why? Industrial, trading and distribution, retailing, and finance. If you see, both types of businesses, Renault Company and Halson, they are giving the profits. Only the financial sector is giving a loss. So they should invest in the others other than the financials. So uh, this is what is the conclusion for point number B. So this is it about the discussion of chapter number 17. I hope you understand the discussion, but if anything is confusing you, do not hesitate to write in the comment section. I hope you enjoyed the discussion of corporate financial reporting. See you inshallah soon. Take care everyone.